Both house prices and interest rates are falling, and housing affordability still hasn't been restored in Canada. Welcome back to my channel. Today we're going to talk about how both the housing market and the Bank of Canada are a little bit trapped in trying to get affordability back into the Canadian real estate market. And stick around to the end because I'm going to talk about two government policies that I think will be on the table to be changed in the next couple of years in an attempt to resurrect Canada's housing market. We're going to start off by covering the Toronto Real Estate Board's May statistics. I'm going to follow that with a look at housing affordability according to the Royal Bank of Canada. Then we're going to touch on Bloomberg's take on what it would look like to get housing affordability back to pre-COVID levels. I'm going to move on to how the Bank of Canada is looking at house prices, incomes, and productivity as a measure of the success of their policy and how they might have trapped themselves a little bit there. Finally, we're going to get into how typical rate cut cycles work and what happens to mortgage delinquencies when interest rates start getting cut. And before we dive in, as always, if you like this content, there is hundreds of hours of content just like it on our course and investor community, which you can find at realist.ca. We're always looking for members and like-minded individuals to join the community. There's a very full calendar of masterminds and workshops that will help you not just get a better understanding of Canadian real estate, but also be accountable to working on your craft as an investor. Okay, let's dive in here. House prices are down, but still not affordable. House prices in the Greater Toronto Area are down in what I would call a meaningful way. So if you consider adjusting that for inflation, that would mean that, your inflation, let's say, was 2.5%, or so your house prices actually fell in real terms by like 5%. Not really what I would call a ripping bull market. The other piece, and the piece that's hurting the real estate profession more, is that home sales were low at like 7,000 transactions, which is like 21% below May of last year and well below the historical average for the month of May, which is typically, and this is kind of the part that's a bummer, if you look at the historical averages, May is typically the peak sales month for your spring market, and then volumes actually fall off after that. And so it would be reasonable to expect that we will see volumes continue to fall into the summer as families kind of take the summer off and aren't really thinking about buying houses. This huge drop in transactions has led OREA CEO Tim Hudak to publicly call for rate cuts. This is something we've seen a lot of politicians do lately and has always confused me because central banks are supposed to be politically autonomous. And I, as someone who really likes that institution, it bothers me a little bit to see politicians not being respectful of that. I've talked about this a couple times on my channel before, but if you look at markets like Switzerland or Germany or the UK, you don't see a lot of real estate transaction there. And that's because they have low home ownership and high housing unaffordability. In the UK, actually, private rentals just became the primary type of household tenure in London after 30 years being led by mortgaged home ownership. And this is something we're seeing. It's incredibly common in the Western world. And it's only going to become worse in Canada because our housing affordability is not recovering at all, even though house prices are falling and even though interest rates are coming down. How could that be? Well, if we look at this chart here from Bloomberg, they show that in order for Canada to get to pre-COVID affordability, they would need to see a decrease in house prices of 33%. A lot of which we've seen already from house prices off peak when this was measured. We would need to see a 55% increase in incomes, but obviously that's economically risky, and I'm going to show you why in a second. Or we would need to see a 350 basis point decrease in mortgage rates, which I think the Bank of Canada just basically said is not going to happen. They said that people should not be expecting rates to come down to even close to the levels seen during the pandemic. And so house prices, which are continuing to fall, have already done a lot of the work to restore that affordability, being down like 20 to 30%, depending on which metric you use. Mortgage rates have only just began to come down 25 basis points this week, and incomes have risen about a nominal 2.5% since that index. And that's probably not going to increase much more given that we are heading into a recessionary environment with rising unemployment and massive population growth that is adding to the labor pool, making it harder to compete and that can be deflationary on wages. The Bank of Canada acknowledged this in their most recent press release with the rate cut, where they said inflation could remain high if house prices in Canada rise faster than expected, or if wage growth remains high relative to productivity. So basically what this means is the two things that would respond positively to interest rate cuts, house prices and incomes, can't rise too fast. And so they're going to be very cautious in their hiking cycle. And you would hope that they're not using GDP per capita as their productivity metric, because it's basically been falling for 7 consecutive quarters. So even if wages aren't rising and our population growth is still so high, your GDP per capita is going to be declining. The Bank of Canada is really stuck where, when it comes to restoring housing affordability, growth in wages or house prices would decrease their likelihood of further interest rate cuts. Even though we've seen this huge decrease in demand with sales being low for the last 2 years, we're starting to see inventory or supply pile up, with the condo market having more listings than it ever has before. And a lot of people are optimistic that these rate cuts are going to become the beginning of the next bull market for Canadian real estate, how it'll help solve our unaffordability challenges and low volume sales challenges for Canada's real estate market. But the problem is that this comes at a cost. Delinquency rates typically rise after rate cuts take place, and this happens for 2 reasons. Number one is rate hikes typically lag. They have a big lagging impact, and it takes a while for that to be felt by borrowers. The easiest way to think about this is your mortgage payment goes up, but you only have to pay that mortgage once a month. And so it would take you, 5, 10, 20 payments before that really starts to be painful for you. The next piece is that central banks typically cut rates in response to bad economic data, which leads to more bad economic data, such as rising unemployment. And as Tiff Macklem said himself before rate hikes started, the biggest reason people would not pay their mortgage is not having a job. Now we're getting to that phase with unemployment in the GTA being significantly higher than unemployment elsewhere in Canada. And unfortunately, the Bank of Canada uses Canada data. It's not the Bank of Toronto. So the last piece is, what could the government do here? We've determined that house prices are doing their job in trying to restore affordability. The Bank of Canada is going to try and do their job in restoring affordability cautiously, as I mentioned. What else can be done to get housing affordability back, to get buying power to increase? These are the 2 things that are on the table, given that my last video mentioned how the government is interested in keeping house prices propped up, but they're also interested in restoring affordability. These are the 2 policies that I think are on the table to make that happen. Number 1 is rolling back the B20 stress test. And this is where it's interesting in the context of thinking about the Bank of Canada. And it fascinates me that politicians are putting so much pressure on Tiff Macklem and the Bank of Canada, given the political autonomy of the Bank of Canada. And it surprises me that we haven't seen more political pressure on Peter Routledge here, who is the Superintendent of Financial Institutions from OSFI, who is on a 7-year term. So he was appointed on a 7-year term ending in 2028. He really likes the stress test and he's proud of it, and he should be. It did a really good job. It's probably the reason that the market hasn't collapsed in Canada yet. With that being said, because of that, I think it's incredibly unlikely that he rolls it back. But I'm surprised we haven't seen politicians pushing on B20 to do that, because B20, that plus 2%, constricts borrowing power just as much as a 20% increase in house prices or 200 basis points worth of interest rate hikes. The next piece, and this is again one that I don't necessarily think is a good idea, but it wouldn't surprise me to see the government do this in an effort to try and bring some demand back to the market, is on February 4th, 2024, they announced their intention to extend the existing ban. I don't know how this stuff works, but I'm assuming that, maybe if they intend to do it, it just gets extended automatically. I don't know, because it's an independent act, which is the Prohibition on the Purchase of Residential Property by Non-Canadians Act. But basically, the CMHC website also states that they announced this intention. And Canada's Housing Plan, which I was actually impressed by, announces an intention. The fall economic statement has no mention of the intention, but in the budget, there's yet another proclamation of the intention. And I would assume that if they were going to actually do this, it would have appeared in the budget. But again, if somebody wants to let me know how this stuff actually works, policy, do it in the comments, because I'm happy to be wrong here. I just don't really get it. But it wouldn't surprise me if come 2025, it just wasn't renewed and foreign owners were able to purchase real estate again. In Ontario, I think foreign ownership has dropped from 5 to 3.5%. And that happened as a result of the non-resident speculation tax. So I don't see it really ramping up massively, but it could help bring some demand back to the ailing Canadian real estate market. So neither of these policies being considered by the current administration would surprise me. I'm interested to see how it plays out. I would love to get your thoughts on what you think is going to happen. What do you think of prices coming down in the city of Toronto? What do you think of interest rates coming down? Do you think that the market is going to see another down leg, or we have further price reductions ahead? Let me know in the comments, and let me know what you'd like me to discuss in the next video. Thanks a lot, and I'll see you next week.